lenders can make a ton of sense because you can hold on to more debt and not liquidate other investments. So if you have any entrepreneur clients, they will love you. If you can even trigger this in their mind, it makes so much sense, right?
Hold up.
Thanks everyone for being here for our first Thursday of the month meeting. So this is going to be an ongoing training that's going to be it's going to be around helping you guys be more productive, do more sales, engage your clients better, follow up better, and just be able to increase your results. So Paul and I actually met online. We met on LinkedIn about almost 2 years ago now.
Yeah, wow, time flies. Look at that. Yeah,
time does, man. And we've worked on some other projects, marketing wise. Paul also has a media company that he runs in BC, but he has a team running in BC. He's currently in Toronto. We connected on LinkedIn. I reached out to him initially about his media company, but then learned about what he also does on the mortgage side. And I thought it would be very cool to incorporate those two elements together, not only financing, but also be able to, make your online presence look really, really cool. So part of my online presence, this is the man that's responsible for it. But I also wanted him to, come here today to share a little bit about mortgages, and especially now with how the market is, it's very important to be as educated as possible. That way you're not wasting as much time with your clients and you're getting more stuff through the door, you're qualifying people faster, and you're making sure they're pre-qualified before you go out hunting for deals and so forth. Paul, the other thing that I really appreciate about him, and just in the last couple of years of working together, is he's not afraid of going out there, getting dirty, getting his hands dirty. He's a sales guy. I'm a sales guy as well. We both wear that very, very proudly. We hold each other accountable as well, with KPIs that he makes sure that I'm currently doing, whether it be a certain amount of calls, certain amount of reaches that I'm doing to, to my prospects. So that synergy that we've created over the last little while of our own little mastermind team has been very valuable for me. And I thought it would be very cool to incorporate him into what we're doing here at Dreammaker, and for him to share his experiences, give you guys more knowledge, more power to help you guys go out there, execute better, know what kind of financial products are available, whether you're looking for your service and first-time home buyers, you're looking to refinance, you're looking for move-up buyers. He will be able to kind of go through everything and give you guys a tremendous amount of value. And then at the end of it, I'll come back and I'll talk about how to sell pre-construction in this crazy times that we're in, and things that everybody needs to be doing. So if you can stick around after Paul is done, and if you need to go, you have things and obligations you have to take care of, that's fine as well. So without further ado, Paul, I'll give it right up to you.
Awesome. Thanks for the intro, Mike. It's been really cool working with you. And you're right. Everything started from a LinkedIn reach out. And I think it's going to tie in some of the things we talk about today. There can be some really great connections made by just getting out there. So would you like me to share my screen, or do you want to share my prezzo on your side of things? Either or works.
No, share your screen, please. I'm going to stop.
Okay. Cool. All right. Who do we have on today? Got Ryan, Chris, Jordan. We got a nice intimate crowd, so I'm excited to get to know you guys. You may have noticed a new Instagram follower, a couple of you, by the way. So look forward to connecting. Okay, let me just share my screen really quick. Yeah, I got a dual screen thing going on here, so I got to figure out how to get onto the screen. Give me a sec. Okay. All right. So share my screen. Perfect. All right. Here we go. You guys see the screen okay?
Yes, it's coming up.
Coming up. We're good?
Sweet.
Okay. Great. Well, again, thanks for the intro. And we're not going to be able to cover everything in today's deck, but I hope there can be some follow up conversations to this. The point really is to create some spark to help you sell more and sell faster because we're actually at a really pivotal part in the market where you have a lot of different forces, both good and could be perceived as bad, to create urgency and educate buyers to make a move if in fact it is their time to do so. So yeah, pretty excited to sort of walk you through that. I guess really quick. Firstly, I always like to start things with a bit of a story. And this is actually us on Dragons Den, part of my team. It's about a half decade ago, and this was when we went and we pitched an app that actually didn't exist yet. Didn't exist. Wasn't launched. It was in the ideation stage. And luckily, if you guys remember Kevin O'Leary or Mr. Wonderful, he had left the show about a week before we went on, which I was just like, woo, because he would have torn us apart. He seriously would have. I mean, and most people thought we were going to get laughed off stage. So we went on, and our whole strategy was since we don't have a product, like nothing that they can see is tangible, we need them to buy into our vision of why they should give us their money and make a big purchasing decision, right? And really, at the time, we started as a restaurant marketing company. So we had this app and we sold a vision of how people make decisions, not just off of what the star ratings are or going on Yelp. They went off what their emotions were, their mood, what they were doing with other people. It's kind of like, Spotify meets Yelp. And again, this didn't exist at all, right? And we didn't have a lot of money or an app to show. So we had to really sell a vision. And it was all through education, educating them on the market and the opportunity. Now, when we went on, we realized quickly, to our surprise, they didn't know much about technology. Like we were saying really basic technological terms, and like they didn't get it, which was surprising for investors who see a lot of pitches. This is back in 2014. I'm sure they're a little bit more sharp now. But the point here is that mid pitch, we have to go off script, much like when you're talking to a buyer and their education level is not where you expected it to be. Like something that's so obvious in your head why they should buy this property, but they may not know, right? So kind of like with that parallel, we have to go off script and we have to educate them on a bit of the basics of technology and why the vision of what we were doing is going to make sense. And this was the thing that helped us get an offer. And after the show, we actually got a deal. Now, there's a backstory to what they offered us and what we got off the show, but that's for later on. Now, the light bulb moment for us and what I hope to convey to you today is that if you want to convince people to make big spending decisions, you got to sell it through the power of education so they can make their own decisions. There's no convincing here. They're going to convince themselves, but if they convince themselves through emotional decision making, which is something that really irks me because it makes zero sense, right? It really doesn't. It's about the numbers and about getting educated. So that's just a bit of a story on, again, a bit of my roots on how I pitch for money through education, whether it's of course, of my clients to make a decision, perhaps our shared clients, and or for an investor like a lender or a dragon to give me money. It's all about the sort of process. So that's just a bit of the flavor for today. I mean, you obviously heard the bio, but what I want to focus on here, just give you a bit of like just things to keep in mind on like what makes us different. I think it's really important differentiation, right? Especially you as a realtor. There's so many realtors. There's 50,000 in Toronto. How do you stand out? A bit of like our background is that we're not the typical mortgage brokers, right? Like we actually got into this industry because, as Mike mentioned, we've got a marketing and media business, both in Vancouver, now in Toronto, actually. We're at the Queen and Bathurst office. And like we started working with mortgage brokers, realtors, and started to realize that they could find ways to sell to their clients through education. But what we realized is that a lot of them, and I'm sure you found this too, there's some mortgage brokers, right, who aren't the best at educating your clients and communicating to you on where the deal's at. Who's had that happen? Maybe a raise of hands or, just kind of acknowledgement on the chat. Like, it's kind of obvious. And it was surprising how this was a gap. I thought it would be a basic thing that was just done, right? And then also, as I talked about, clients make a lot of bad emotional decisions that can be rationalized of actually running the numbers, having education on the market and proper storytelling, right? So that's been our genesis. And again, I want you to be able to educate and help clients be more profitable in how they make decisions. And it's not just about getting a rate. That's top of the iceberg. A low rate is top of the iceberg. It's more about saving with cash flows long term and being poised to invest by working with a lender who's going to lend you money, not just for this property, but the next 2 or 3 properties, right? That's what the people overlook. They look at the rates, but they don't think about the bigger picture on opportunity costs. You can have a $500,000 home with the best rate in the world and then be limited to getting 2 more investment properties, which if you add up the money, it makes 0 sense if you want to be profitable. So those are all things that I hope to, of course, dive into. So yeah, again, that's just a bit of like the mindset of where we're at. And for the agenda, the first 2 points I'm going to go through. I want to get a bit of a vote, anywhere from points 3 to 6, right? These in the quotations you have like what people usually ask me or like a question you might have. I'm curious whether it's 3, 4, 5, and 6. Which of these, if we have time, do you want me to cover? So maybe you can type into the chat if you like. Which one you prefer. Just pick a number, 3, 4, 5, 6. You can of course speak up too if you want. And Mike, I'll let you pull that and obviously let me know what the big vote is. But yeah, no, excited to see how much we can cover here. So getting kind of right into it, let's get into the first topic here. And that's around non-stress test lenders and also B lenders. And usually they are triggered by a client saying, or you saying, my client cannot afford enough mortgage from their bank, or the client telling you, I can't afford enough for this. I can't get to a bidding war. I'm out. I'm just gonna wait for the market to change, right? Which we all know, the market goes up and down, upwards, right? So waiting isn't good. Now, most people assume that the bank is the be all end all, but as many people on the call may know, there are non-bank, what are called monoline lenders. They're just mortgage lenders who don't have retail locations. You might have heard of MCAP, First National, Home Trust. And there's a bunch of credit unions as well that, again, like either don't have retail locations or aren't a bank. And they have a lot of stigmas that I want to sort of demystify in a little bit here. And also, when you look at the numbers, these are lenders that are going to help you sell much bigger properties and be able to sell to a client why these lenders ain't that bad. Even though the rate may not be under 2%, they make a lot of sense in a lot of ways, especially if the client's goal is to save on cash flow. So, quick story. Here's some clients I helped recently, and these guys have enough money. They actually qualified with a bank, right? A prime best rate lender, but they actually chose an alternative lender. And the rate was about like a percentage higher. Can anyone think about who in the right mind who can get a rate below 2% would get a rate at I think they got a 2.80 rate. Just not bad for a B lender. Why would they do that? Well, the biggest thing is debt. As some of you may know, there's a stress test, which is being changed June 1st. Now it's stricter. Basically, they put an artificial buffer that makes clients afford less. That's the simplest way to put it. And all the affordability is based off their debt and their income. There's a special ratio, right? And banks are the strictest with this. And federally, they're regulated to be really strict with it, right? So in this case, this guy had a lot of debt, ton of debt. And he also had a lot of money invested in Tesla stocks, right? Which, I mean, 6 months ago, we're doing especially well. So he's like, well, wait a sec. They want me to pay off more debts, which means I have to liquidate Tesla stocks, get taxed, and then lose on the upside of Tesla stocks continuing to increase. If I talk to this client today, it'd probably be him and his Dogecoin. He would not want to liquidate his Dogecoin yet, arguably speaking, for the crypto nerds out there, right? So he said, screw that. I'm going to pay, Paul, run the numbers for me. I said, okay, look, if you have a higher rate by a percentage, which, and by the way, B lenders are usually 1 to 2 year term. So short term, what if you take this rate, you're paying a few $100s more per month, but the money that you would pay at the lower rate by liquidating your stocks, getting taxed, and then losing out on even modest growth in Tesla is like 5 to 10 times higher. So his opportunity cost was 10 times higher than just going for a higher rate. And he paid a 1% lender fee and a broker fee, and it still made sense. This is an extreme example, but if you run the numbers, ladies and gentlemen, like alternative lenders can make a ton of sense because you can hold on to more debt and not liquidate other investments. So if you have any entrepreneur clients, they will love you. If you can even trigger this in their mind, it makes so much sense, right? Not to mention, if you don't have the best credit score, a lot of lenders can get over that on the B side. So this is like an extreme example I wanted just to highlight. And like, why are alternative lenders more important than ever? So 3 key factors and things you can talk to clients about. There was a stress test change. Who knows about the June 1st stress test change? I'm feeling some nods, although I can't see most of you. So June 1st, the benchmark is changing. So I mean, high level, as you see in the title here on my blog post, your buyers will lose 5% buyer power starting June 1st. So literally, if there's a home your client is looking to get that's worth $1 million right now, on June the 2nd, they will be pre-approved now for a $955,000 property. So they lose $45,000 overnight of buyer power. How do they make that up? Well, they got to pay off debts. They got to put in more down payment. They got to go with a B lender. This is something for you to add urgency for people that are on the fence, but have gotten pre-approved or about to get pre-approved. Like, this is seriously something that can add the right amount of urgency. Secondly, COVID has created a lot of entrepreneurs. Maybe some of you guys have your side hustles. You're all entrepreneurs, of course, because we all run our own businesses, right? So because of the surge of entrepreneurs, more alternative lenders are creating more abundant programs that are friendly to entrepreneurs. As you may know, entrepreneurs need a 2-year average to count their income. If you just started it within 6 months ago, some B lenders will only need to look at your last 6 months of bank statements, which is a huge upside than having to wait 2 years to buy a property. So COVID has helped lenders be more entrepreneur friendly, and the surging home prices, right? Alternative lenders help you afford more. There's a higher ceiling. So if you feel like you're losing in a bidding war, or just your clients are like, I don't know if I can afford that, B lenders can help you do that, especially in this market. So they're so important. So a B lender and alternative lender, by the way, obviously used synonymously. We're not talking about private lenders. Those private lenders are interest only, rates starting at 7%. Those work in some situations. But here we're talking about B lenders. You pay principal and interest, and sometimes the rates are as close as they are to the bank. Like, I'm seeing the lowest B lender rate are at 2.5. I'm seeing some banks now at 2.3 fixed rates. Like, nothing of a delta. The difference is nothing. Here's actually like a really interesting example with one B lender in Ontario, especially. And look, the rate is 3.79. So like, I can see your client being like, I don't know, that seems pretty high. I don't know if I want to do it. Well, let's say we can break down a 3.79 into a story and what it does. So 3 key elements of this B lender. So they actually don't stress test. Usually it's credit unions that stress test. These guys don't, and that's huge. 40-year amortization. Remember, most amortizations, of course, the length of the mortgage loan, not the term, right? The total lifespan. Usually it's 25 years. To extend it 40 years, 15 more years, the same mortgage, by the way, gets stretched. So what happens when your same mortgage gets stretched? The monthly payments go down. But by how much? Let's run some math. So those are some highlights, of course, you guys can read on. So here's an example. Let's say you have a client. They're gonna get an $800,000 home. Well, that's how much they can afford. They want to go to $1 million. They got 20% down payment. They can get a 1.85 variable rate, let's say with a bank, which is okay these days. I'm seeing the rates as low as 1.3. Again, that we'll save that for the end on the current rate update. Their monthly payment would be $2,300. Okay. Let's say they go with this B lender where they pay a higher rate. However, they can stretch out their mortgage for longer and they can afford more. What will that do? Look at that. Literally a 2% difference in rate, and they're paying $265 less. Probably less than you thought. If you show this as a client, you're like, whoa, 2% rate difference, it's going to be a fortune. Just over $200. Why? Because you stretch out the amortization. And now the most important thing here, beyond, of course, conserving cash flow, is the affordability went up 200,000, at least 200,000. So here's an example of how the cash flow can stay almost the exact same as the prime rate lender, but now you can afford so much more, and therefore the appreciation of the property, the rental income they can claim is going to be higher. So once you run a bit of math here, who cares about the rate? It's your cash flow. That's what really matters. So that's just an example on just B lenders that are becoming super competitive, especially for investor clients. And just to summarize, who uses the most? Self-employed people who, again, have not worked 2 years, or they don't claim a lot of taxes. So therefore, their claimed income doesn't allow them to afford a lot with a traditional bank. As we talked about, people who want to afford more. And if they've been through a bankruptcy or consumer proposal, a little bit different, right? There's a lot of ways that they can, of course, get around that. And again, the misconceptions we all address right now. So I'll take a pause. Are there any questions in the chat, Mike? Or if people want to speak up, go for it. I know I covered a lot on that. That could be a whole presentation. Maybe it's what we'll focus on today, actually. But thoughts, questions on that?
Yeah, guys, if you have any questions, please just drop it in the chat, and I can get it started. I've actually never heard of a 40-year amortization. Is that normal for B lenders?
No, super new. From what I know, it's just this lender that does it. There may be one over out there. There's 35 years, but 40 is a brand new program, which is insane. Like it is such a timely thing to release right now.
Wow. Okay. All right. Thank you.
You bet. Side note, I see that remaining time is 8 minutes. I guess, I don't know if you're on the pro version. If there's a way to renew that, then we won't get kicked out of the meeting. But otherwise, we can just jump back on.
Tasha, that'll be for you.
I'm upgrading it right now.
Okay. No worries. Okay,
Thanks,
cool,
Paul.
cool. Yeah, no, you bet. I've had happen to me way too many times. That's why I'm pretty prone to it. Okay, so there's more stuff on B lenders. I'm just gonna skip through these examples, but again, later on, happy to show you how they all work. Yeah, lots on self-employed stuff. Okay, all right. So a lot of you probably have clients who have equity, especially after the surge in equity that people have now because of the appreciating home prices. They have a lot of equity to play around with, and few people actually realize they can take it out and use for down payment, right? A lot of people are going to say, I don't have $200,000 for a down payment right now. Well, it's in your house. You need to unlock it. Let's talk about a little bit about how that might work. Okay. And by the way, this is very timely because, as we talked about, there's more, not beyond just more equity. There's, again, B lenders who can help you afford more mortgage, so people can stretch out a little bit more. And because of the stress test change happening June the 1st, if you want to go with a bank, your buyer power is going down. That's either you're refinancing, taking out equity, or buying. So again, converging forces to help you add urgency, right? That's what it's all about. Okay. So, let me just, okay, here's a story. An email that I got about 3 months ago. Lisa says to me, Paul, we want to refinance because we're paying a criminal 3.5 fixed rate, which in today's market is criminal. We also want to do some renovations and potentially get a down payment for another property. However, and we need to consolidate debt, as you can see. However, what the hell? We have a $27,000 penalty because we chose a fixed rate. By the way, people like fixed rates. If you like a fixed rate, but you break your mortgage, like 60% of Canadians, for many reasons, you sell your house, you get divorced, you want to get an investment property, so you need to refinance and change the terms of the mortgage, always to break your mortgage. So she's got that in her way. When I ran the numbers and I said, hey, if you break the mortgage, but you go from a 3.5 to a 1.3, special rate I got from a TD, in the next 5 years, after you pay your $27,000 breakage penalty, and of course, after you start to pay down some debt and you no longer have interest charges, you will be $45,000 better off. Which sounds a little bit like bogus, but when you look at the spreadsheet that I showed her, she was in disbelief. Because when you run the numbers, the emotional part of your brain, i.e., oh, there's a penalty, not going to do it, not going to go for the opportunity cost. You break it down in numbers, it makes sense. So she did it in a heartbeat after she saw the numbers. Again, something that perhaps some of your clients may need a bit of. This might be an objection you get. Oh, I don't want to break my mortgage. I don't want to get a penalty. Well, what's the rate you would get today? What's the difference in the rates and the amount you will pay less per month starting today? And what about the 5-year projection? Again, things I can do for you guys, but that's how you get people who are even somewhat rational thinking about making a move, right? So again, we talked about refinancing is more timely than ever. Fixed rates are going up, as you've noticed. So again, it's a tightening window where now's the time to refinance, to change your mortgage terms, get a better rate, take out equity, and look at an investment property. Like, people should be refinancing ASAP and just have that money for whenever the heck they need it, hopefully sooner than later. So just like some basics on how a refinance works, and while this might be a review for some of you, this might even be helpful in how you explain it to a client, because they may ask you, like, how does it work? So you must always own 20% of your home. That is the rule. Okay? So anyone who bought a house and has under 20% down payment, they cannot refinance. But let's say clients who've been in the market for a while, and they started with 20% down payment, and they paid off their mortgage the last 10 years, and they've grown in equity. They've got tons to play with, right? So quick trivia question. Your client has a $1 million home. They own 50% of it. How much equity can they take out? What is their ceiling based off of the rule of 20%? Who wants to take a stab and put in the chat? Mike, you can orate, or else, Mike, you're gonna have to answer. What's the max they can take out? What's that?
I'll say, well, Ryan has an answer below in the chat.
Okay, what did he say?
Ryan Ratto said 300,000.
That is correct. Nice, right? So they have $500,000 equity. They can only take out to the $800,000 ceiling because they need 20,000, i.e., 20% left. Yeah, exactly, right? So that's the basic math of how to walk people through. Just like when it happens, by the way, there's usually an appraisal, of course, to make sure the property is valued where it's valued, and there's some legal fees. $1,500, small price to pay for a huge gain you can get, right? Timeline wise, especially if it's backed up a little bit, it can take 3 to 4 weeks. It can be faster, but it can take a little bit of time. So just budget for that. And remember, they need to be able to qualify, right? So they're going to be put through the stress test, which is going to be a little bit harder on them starting June 1st. So refinancing before June the 1st are timely. Now, if they don't make income because they're retired or whatever, of course, there's reverse mortgages that can fix this problem. There are some other more innovative products that are, I think, a bit better than reverse mortgages, and not just for people over 55. Talk to me offline if that's a case for you. But there's some alternatives now, right? So that's kind of how refinancing works. I know we're probably running up to like maybe 5 minutes left, so I'm gonna pause for questions.
No,
perhaps.
that's fine, Paul. That's fine.
Okay.
Go ahead.
Okay. Well, look. The next sections are pretty basic. They're just around, like, if someone needs to sell and buy at the same time, what do you do? I mean, basically bridge financing. And honestly, I think we should save this for another day, because it's a bit of a deep dive into spreadsheets and all that. But if you have someone who's buying and selling at the same time, and they want to know about bridge financing, and also they want to know whether they can qualify for the bridge finance, because remember, they might have too much debt. There are ways to refinance first. So you restructure your mortgage, you pay less per month, therefore you qualify more because your debt to income ratio gets a bit more favorable. So refinancing might be an important pre-step to someone then buying and selling, or buying another investment property, right? Yeah.
I have a question, actually.
Yeah, shoot.
When it comes to your side income and your side hustles, a lot of people don't declare or file taxes on their side income. So if someone comes to you and they're short maybe 30,000 in income, but they've been making about 35, 40,000 on a side hustle a year. I mean, would you have to have them first file their taxes to be able to use the income, or how would the side income conversation even be incorporated into them?
Great
getting a
question.
mortgage?
Yeah, depends on what route they want to go. If there's still time to file your taxes, here's a trade-off. You're gonna get taxed on that. So how much are you gonna get taxed? Do the math on that. And then, but if you claim, you have to claim all of it. Like we would do a break-even analysis. Right now with the income you're claiming, how much can you qualify for? Quick rule of thumb, their income times a multiple of 5 is how much mortgage they'll get. They make 100K, great. $500,000 mortgage is about the mortgage you'll get, assuming there's no debts, right? If you need a $600,000 mortgage, then how much more income do we have to claim to get the 600? Right? Divided by 5 of the delta of 100,000. So you need to claim 120,000. So the extra 20,000, if you made 40,000, just claim 20 of it. Get taxed on that, but now you can afford exactly where you want to go. If you need to claim all of it, you claim all of it. If it's too late to claim it, right? Then what you do is you just go to a B lender. Hey, B lender, here's my bank account. Like they'll tell you, give us 6 months of bank account statements, and we're gonna add. So let's say per month it says you make 20K in them. Great. If you keep that consistent, we'll then times that by 2 to extrapolate your 6 months earning to a year earning, and we'll go off of that. Which could mean if they have a good 6 months, it means they can make a ton. This is all current income and future income. But of course, there's a 1% lender fee, could be a broker fee, and the rate might be high 2s, low 3s, maybe low 4s, right? But again, these are all just simple things you run the numbers with, and you have different scenarios, and then you act. But there are definitely options. You have side income. Let's do the math on that. Why wouldn't you claim that? This is tips as well. People who work in the service industry, all those things. Man, there's a big rule of the banks: 2 years. That's all we want to see. If you don't have 2 years of claimed income, see you later. No. Things are changing, and some A lenders actually are starting to even allow you to boost your income through stated income. You can actually, like going back on Dragon's Den, you can pitch how much you should be making based off your profitability. So I do that with clients, and there are some A lenders who are actually entertaining what are called stated income programs. I have those on my blog. So yeah. Anyways, so bridge financing, again, if someone's like buying and selling at the same time, and the house that they're selling closes after the place that they're buying and they need down payment, there's a way to get around that. Usually has to be within 90 days. So something we can talk about later. So I'm going to skip right to the end here. And I know Mike wanted me to cover first-time homebuyer programs, right? And it's timely as well because as of this month, there's a change to one of the existing ones, which we'll talk about in the next slide. But yeah, I mean, look, in Ontario, really for your clients who ask you about like land transfer tax rebates, I mean, pretty pathetic that 368 is the ceiling to get the full thing back. Like it's a joke, right? Like what? But at least they will get 4,000 back if their house is over that, which is nice. Right? So basically, they'll likely get $4,000 back as a first-time buyer. Now, the home buyers plan is another great one. This is a federal program, by the way. And actually, the cool thing is that, just so you guys know, a first-time home buyer provincially, most programs are provincial. Their definition is, if you've owned a home anywhere in the world ever, you're not a first-time buyer, as the name implies. You can't qualify for these programs. Now, federally, though, and federally, they do the home buyers plan. If you haven't lived in a home that is yours the last 4 years, they reset it and say you're now a first-time buyer. So clients who might be in that circumstance, who are now renters, owned in the past, they could qualify for this. And basically, you can use up to $35K of your RSP to put down for down payment without getting taxed today. You get taxed later, but you're deferring taxes for you to be able to, use that for down payment, which could help a lot with liquidity and cash flow today. That's really important. And then we've got an HST rebate, which basically, you're basically getting 24K back, right? If you read kind of the fine details of how it works, this is a great one. So yeah, pass it by me if you like. This isn't just for first-time buyers, by the way. This is for anyone buying a pre-sale. As I'm sure a lot of you who sell those are aware, this is something around the HST rebate, which is great. So the first-time homebuyer incentive program, this you may have heard about. They kind of launched it in 2019 September, and it didn't take off because, again, the ceiling was a house could be no more than $520,000, and the idea is that they will match your down payment up to 10%. So I've got 5% down on a $500,000 property. That's 25K down that I have, but I can only afford 450 mortgage. So 450 mortgage plus my down payment is 475. I'm 25K short. What do I do? I can't extend the amortization period because I don't have over 20%. Can't go to 30 or 40. So they'll match my 5%. So I put in 25K, they put in 25K, and now the 450 mortgage plus the 2 down payments equals 500,000. Now, what's the catch? Well, they own equity in your property. And like any entrepreneur, like when you go on Dragon's Den, they offer you a lowball BS offer, which we got, of course, offered, right? It's something you want to turn down because as you appreciate, as you gain value in your company, they monetize off your upside. So you sell your house in 10 years, 20 years, worth double, they're getting 50K back, not 25, which fair enough. I guess they're investors. So they're investors. They're not really doing it from the goodness of their heart. They're investing in you, right? So, but again, it might be worth it for some people. What they did actually as of May the 3rd, like literally 3 days ago, is that now the ceiling is 722,000, not 500. So if a first-time buyer is buying a place up to 720, and assuming their income makes sense, because also the house and the mortgage total and their subsidy cannot be more than 4.5 times your income. So if they don't make a lot of income, then their ceiling is a lot less than 720. Again, this will take you a bit of time to process how this works. It took me some time, but anyways, I can go through it with you later on. But for what you should remember right now, first time buyer, don't have enough mortgage to afford a house up to 720. Maybe this is a program I can connect them with Paul to talk about. Right? That's mainly it. And by the way, if it's a pre-sale, they can put in 10% down payment. That's a big detail, right? 10%. So same example before, right? $600,000 home. I put down 60K as my down payment. I get another 60K from the government. So there's more for pre-sales. Yeah, I mean, just to conclude, like ways to, all of this here goes back to what I talked about on slide 1. If you add knowledge, you give someone knowledge that adds urgency and helps them go from an emotional decision-making mindset to a rational one as well, a lot can happen. And again, it's all about timing. The number one question on Dragon's Den, they're like, why should we invest in you right now? Any investors like, why now? Why is now the best time to do it? And same as your clients. They're like, oh, I'll do it later. I got a lot of stuff going on, right? A lot of stuff going on during lockdown. Yeah, right. Now of course there's some unfortunate circumstances which you don't know, but like most people have time. So point is that they're adding excuses to just defer because it's scary to face. But if you give them urgency and knowledge so they understand it, that changes the game. And that's really what I'm hoping. I gave you some ideas around. We talked about rising interest rates from record low. So rates are still low, but they're going up. So act now. There are some spring cashback promotions. I think up until May 28th, TD has a up to $2,500 cashback on day one, depending on the mortgage size, if they close their property or they do their refinance. So that's not nothing. $2,500 for like still a super low rate is great. We talked about opportunity cost. Remember the guy who went from a B lender over an A lender because the opportunity cost, right? If he would have gone to the A lender, he would have to give up his Tesla stocks and pay taxes. So the more you can have people think about, if I wait right now, what's my opportunity cost? Rates going up, harder to qualify, right? And yeah, and of course the property prices go up too. So you're buying the same house with less mortgage after June the 1st. So add that urgency, add the knowledge. We talked about the first-time home buyer incentive. There's even some programs that help that actually help home buyers borrow down payment from a line of credit, and it can be considered legit in certain circumstances. Pretty cool. Only a couple lenders do that. So yeah, there's a lot I gave you there. Just wrapping up. I mean, look, what's the market like today? Here it is, and this will be on my newsletter too. But yeah, there's actually a 0.99 variable interest rate with not a bank. It ain't HSBC. Who it's funny, they if you Google HSBC, they've got a lot of claims about funding drug lords in different parts of the world. That's how I get clients to not work with HSBC. That, and they're also, I mean, really, like you could be on hold for 3 weeks. They're too slammed because they had a 0.99 promotion back in the fall, just for some context. But there's so many strings attached, and like people weren't getting the right experience. But these guys at Radius, they're pretty good. They're going to be better than HSBC, in my opinion. And again, 0.99, that's only if they have under 20% down payment. So you have the column here, under 20% down payment. The top one is fixed, bottom one is variable. But yeah, there's still some pretty good rates. So these are, of course, a handful of the lenders we work with. We work with 50 plus lenders all the way from BC to Toronto. So I have an office in both areas, licensed in both provinces, and I have team members in all over Canada. So really the sky's the limit. And I want to finish off with a Will Smith quote. And this is like what I try to tell clients is like, look, your fear to make a move, to look at the numbers and to think about opportunity costs, it kills your ability to see beauty. And that is getting a brand new home, a new lifestyle, a level up moment, right? A new cash flow asset working for you. But it's just fear. And it's up to us to bring the fear down, motivate them, and help them look at something rationally with numbers and actually understanding how things work. So yeah, that's it. We went a little bit over time, but if there's time for questions, we'd love to connect now, or of course we can do it offline. Just hit me up on the different social networks or shoot me an email. Of course, Mike's got my deets, so I can also send part of this deck as a follow-up for you guys. So just let me know, Mike. But yeah, hopefully that was somewhat useful, and thanks to everyone for the questions. And maybe you want to take a time, Mike, to look in the chat, see if there's any pending questions there. And yeah, I'm all yours for as long as you need here.